Hey, Jason here. Today's video, I'm going to answer the question, should you invest in AI stock Real Networks, stock ticker RNWK? This is an investment analysis for masterclass student FDA 9992. Before I get to that though, I need to let you know you can get this series of podcasts anywhere in the world for free on all major podcasting platforms. Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and our other videos, make sure to subscribe here on YouTube and hit the notification bell so you're notified every time we release a new video. I'm releasing videos all the time. Okay, again, if you've seen my other videos, I apologize for this. I don't want to do this, but I have to do it because every time I don't, I get nasty comments. This is for informational purposes only, to help you learn how to spot potentially bad investments faster so you can stop evaluating them, which will allow you to spend more time evaluating potentially good stocks when you do find them. I've developed this process over the last 15 years for myself and the portfolios I manage. I don't short sell ever. So I don't short sell, so I don't gain on any stock I talk negatively about. I also do not own any stock in a long position about a company I talk positively about. Because these are requested by viewers for every video for the last 3-4 months and every video for the next 3 weeks-ish, I oftentimes do not know what the company does. If I don't know what the company is, if I've never evaluated them before, I keep it that way purposely so I'm not biased either positively or negatively by what the company does. Because of this, I also don't care about what the company says it's going to do. I don't care what the CEO says the company is going to do. I don't care about future growth at all at this stage of my analysis. This is the first stage of my analysis. At this stage, I have to have margin of safety, high profit margins, and some of the other stuff we're about to go through. Why should you listen to anything I have to say? In the first 9 years of my career, I've produced average annual investment returns of 23.5% per year on average. This puts me just behind the great Warren Buffett in the first 9 years of his career at the Buffett Limited Partnership when he produced 24.2% average annual returns. My returns in the last 9 years legitimately make me one of the best stock pickers in the entire world over this time. I'm not saying that any of that to brag. I'm just saying that to prove to you that I actually know what I'm talking about a little bit. Okay, again, apologize for that. Hate doing it. Don't want to do it, but I have to. Alrighty. If this is your first video back, we went through a stage where I was in a bit of a lull because the key ratios tab information went away on Morningstar. It is miraculously back. So I'm back to making more videos. And videos will be better because I can show you my entire process. So, Real Networks Inc. This is stock ticker RNWK. $91 million market cap. Again, love tiny companies. I've said this in many videos. Love tiny companies. You need to be ultra careful with these kinds of companies though, because most companies in this market cap range are not great companies. Because of that, you need to be ultra careful in this industry. Again, even though they are my favorite kinds of companies to invest in and research. Okay. Real Networks Inc. creates a new generation of products that employ artificial intelligence and machine learning to enhance and secure daily lives. Real's portfolio includes Safer, computer vision platform for live video, Context, and NLP, natural language processing platform for text and multimedia analysis and leveraging its digital media expertise. Bubble Games business focused on the large free-to-play segment. It's a bit of a confusing statement. So let's go to their homepage. Their homepage is not much better. Their products and employee business. Okay, this is helpful. Real Networks has created a new generation of products that employ best-in-class artificial intelligence and machine learning to enhance and secure our daily lives. So they are using AI to make digital lives, internet, phones, tablets, blah, 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 everything we use every day to become more secure with machine learning and artificial intelligence. So that makes sense. I don't understand what that has to do down here with the mobile games segment. That, you do know what that means. They might have a mobile game segment. They might be using this technology in a mobile game segment. It's not really clear here. If you have context on that, let me know. Okay. Their revenue has cratered from 2011 at 336 million to 67 million in the trailing 12-month period. I'm guessing there was a massive change in their business model. Well, that works. Business change. Napster? That's interesting. Who knew Napster was still even around? I didn't. Can't read this because I don't have access. Always love that kind of stuff. So many things coming up. Okay, well, again, if you have context on that, their business change. Let me know, because I can't tell from here, and the articles I want to read are either not good or they're blocked under a paywall. So if you have context on that, the reason I'm assuming they have had a massive business change is not just because of their fall in revenue. It's also because AI, as we kind of currently know it, has only been a truly kind of functional thing in the last like 3-4 years. Definitely not back in 2011. They might have been working on some AI stuff, but it definitely wasn't in its current form. So that's why I'm assuming there's some kind of massive business change here. Actually, let's go. Our story. I was already on our story. It doesn't say. Okay, so let's get back on track. Operating margin is hugely negative. Negative 8%, 8.6% in 2011, skyrocketed up to negative 51% in 2015. Now it's back down to negative 15.1%. But over the last decade, they've not been profitable in any one year on an operating income basis. They've been profitable on an net income basis once in the last decade. They've had negative free cash flow every year in the last decade. None of those are good, of course, especially if you've seen my other videos. Their share count has gone up slightly from 34 million in 2011 to 38 million in the trailing 12-month period, but their book value per share has cratered from a high of $9.70 per share in 2012 to only 78 cents per share in the trailing 12-month period. I'll show you what happened there, but it's most likely due to either divestitures, impairments, those kind of things, and I'll show you that when we get to the balance sheet, and frankly, probably the cash flow statement as well. Their ROICs, hugely negative. Free cash flow to sales, hugely negative. On all these metrics, I look for anything on this one. I look for anything about 5% on a consistent basis. On the other metrics I was talking about, operating margin, ROIC, I look for anything above 10% on a consistent basis. So these are not good. They do have a decent amount of cash on the balance sheet. That's good. Tangibles as a percentage of the balance sheet has gone up. That's usually a sign that they've been acquiring stuff, but not necessarily in this case, because the size of their overall balance sheet has been going down, so that could increase their intangibles, just because it's a bigger percentage of the balance sheet, even though the balance sheet as a whole is smaller. Long-term debt is minimal, which is good. There are some good things. They don't have a cash conversion cycle number because they're a software company, it looks like. Okay, talked about this a bunch of times. I'm going to say it again. Interest coverage ratio, important metric to look at. Anything above +1 is considered good. That means the company can pay for its current interest on its debt with its profits from operations. When it's negative, in this case to a huge degree, it means the company can't pay its current interest payments on its debt with operating profits. This makes sense because they are unprofitable on an operating profit basis, but it's not a good thing. Okay, let's go to quarterly. I'll show you the balance sheet stuff in a little bit. We'll go back to the annual numbers. $17 million in cash and cash equivalents. What was the size of the company? About $90 million? 91. So that's a good amount of cash and cash equivalents. This is not good. Go to the annual for that. Actually, this is not good, kind of overall. Okay, their trade accounts receivable have gone down quite a bit. Why I said that's bad is because that means that, or that could mean that people aren't buying stuff from them as much. That's why that could be bad. It's a pretty significant drop from about 29 million in quarter 2 2020 to 13 million in quarter 1 2021. That's a massive drop. We sold something, or they're trying to sell something in quarter 3 2020 that was worth $90 million. That was probably the Napster thing. Again, who even knew that was still around? Decent amount of property, plant, and equipment. Okay, so they had a ton of goodwill. 328 million in quarter 4 2020. Now they only have 17 million in quarter 1 2021. That likely means there was some impairments going on, which we will find out when we go to the cash flow statement. But let's see what that was. Goodwill. So they had a large amount of goodwill from 2018 through 2020. So I would want to know what happened there, because that's a massive fall. And that is one reason their book value per share has cratered, because goodwill shows up as an asset. Sorry. And when that lowers, it decreases the book value of the company. They also previously had a bunch of intangibles, trademarks and patents, software and technology, customer relationships, other intangible assets, in the fact of about $60 to $80 million, $88 million. They have none showing now. So I don't know what that happened there. That's another weird reason their book value is cratered. Aha. Okay. Accumulated impairment of goodwill. They had to impair almost $311 million in goodwill we'll come back on the annual. That's fine. Which knocks almost $311 million off the value of their book value per share, or book value, and then you take that on a per share basis, and that's one reason, again, why their book value per share is cratered. Why do I keep coming back to that? Because book value is a proxy for the underlying intrinsic value of the company. When that goes down, when it goes down, it's a sign the company's value is going down. When that goes up, it's one sign the company's value is going up. So what does that look like on the chart? That looks like a decreasing share price of about 57% in the last 5 years. That's why book value, or one reason book value is important. In the last 10 years, their shares are down 86%. Okay, that's not good. then they actually impaired that amount in Q4 2020, the 311 million. Debt is minimal, as we already talked about. Okay, so none of that was really good. Especially the only thing that was good was the amount of cash they had, but when you consider all the other stuff, it was net negative in a big way. Okay. Nothing major on their quarterly cash flow statements. Let's go back to their annual to see what that's done, what that impairment did. If it shows up here and here at all, which it doesn't look like it is. Okay, it's not, because that's on the balance sheet. We already talked about that. So this, there's no way I would invest in rural networks. Based on what we've seen so far, massive loss in their share price caused by massive loss in revenue, that caused by massive loss in their book value, caused by impairments, which they've been unprofitable the entire last decade on 3 different metrics. There's no way I would invest in this company right now. And then, of course, you can't see their valuations because they are unprofitable. Frankly, I'm not even going to get into the comparing of the valuations to another company because it's such a small company, it doesn't really matter. But bring my face back here. There's no way I'd invest in this company in the portfolios I manage for the reason that I talked about. Yes, I'm sure some people will come up and say that their future is great, and frankly, I want to hear about that. I'm curious. I don't know about their future. Again, at this stage of the analysis, I don't care about it, but I am curious what their transition has been. It doesn't necessarily it won't affect the analysis for me, because again, at this stage, I don't care what the company's future is or what their plans are, what their transition plans are, any of that. I still don't care. This is more of a curiosity thing. But for the reasons I mentioned, I would not invest in this in the portfolios I manage. There's way too much risk here. There's way too much risk here for the various things I've already talked about. I was trying to think of a redeeming quality and even the cash levels. I mean, if they were selling below their cash, that would change things a little bit. How would that change things? Let's say they had $200 million in cash sitting there and their market cap was only $91 million. That would be very interesting to me. I would look at this more of an NCAV style, not Warren Buffett, NCAV Benjamin Graham style cigar butt stock. But I would still have to kind of evaluate their cash burn, because even in those cases, a company can't be burning through a ton of cash, because if you have a lot of cash and you're burning through a ton of cash, it doesn't really matter. So that's the only way I would look at this stock, as an absolute cigar butt. If they had, say, $200 million in cash. They don't. They have 22 million in cash. So they're not even that situation. That's the only situation, though. But that's massive. It's far away from that. So would not invest in this. Good analysis pick, though. FDA 9992. Appreciate it. Appreciate them as always from you and the others who have been commenting or who have been asking me to request videos. If I missed something, if I didn't explain something well, if I should explain something better, let me know in the comments below. If you want me to make an analysis video like this for you, let me know in the comments below. Every video I've done for the last 3, 4, or 5 months, and every video I've got at least for the next 3 weeks to a month, is from a student. or not from a student, sorry, from somebody commenting on YouTube. However, now that we're relaunching our masterclass on August 3rd and we're starting to get people into it, I will give preference to students. However, if you're not a student and you still want me to look at a stock, let me know in the comments below, and I'll add it to the calendar. Has to meet 3 criteria though. Has to, can't be a bank because I don't evaluate banks. Can't be an insurance company because you actually have to dig into the annual reports to evaluate those. And it has to be producing revenue. Why? Because I've done some of the analysis videos where companies are producing revenue and they're boring because, again, I don't care about the story or anything in the future at that point. This stage has to have minimum margin safety requirements. The future stuff comes far later, and even then it's very minor to me. If it meets those 3 criteria, let me know in the comments below. I'll look at a stock for you anywhere in the world. If you're watching on YouTube, thank you so much. Really appreciate it. You could like, love, share, comment, and subscribe and hit the notification bell. We'd also really appreciate it. If you hit the notification bell, you'll be notified every time I release a new video, and release new videos all the time. If you're listening on the podcast, again, thank you so much. Really appreciate it. And if you do all that same stuff, we really appreciate it as well. But one different thing on the podcast is if you could leave us a short review, letting us know your thoughts on the podcast, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more specific help on how to become a better investor faster, you can check out the free resources below, including our 5 free gifts, which includes the actual worksheet, the written worksheet. We just went through kind of in the visual analysis stage, so you can do it yourself. So you can go through stocks yourself. If you can get that as part of our 5 free gifts. You can also get a free PDF copy of my book, How to Value Invest. You can also get a free copy of our guide, 7 Tips to Picking Great Stocks and 3 Times You Must Sell. You can get all 3 of those for free at the links below. If you want more specific help from me on how to become a better investor faster, check out the link below for our newly relaunched masterclass. Actually, it hasn't relaunched yet. Relaunching officially on August 3rd. Which by the time this releases, it will be released. So, just looking at my calendar, it's supposed to release August 6th. So, make sure to check out the link for our newly relaunched masterclass below. We'd love to have you in there. We're already getting students in there. We haven't launched it as of this recording, but we're already getting students in. We'd love to have you in there as well. But until next time, have a great day. Talk soon.